Final accounts of banking companies. Introduction. A banking company is a company that carries on the business of banking in India and is generally governed by the provisions of the Companies Act 1956 and is also specifically governed by Banking Regulations Act, which came into existence in 16th March 1949. As per Section 6 of Banking Regulations Act, it defines certain classes of business which are incidental to the business of banking, permitted to be engaged in by the banking companies. According to Section 8 of the Banking Regulations Act, banks are prohibited from buying, selling or dealing in goods, except in connection with realization of security held by it, or while negotiation of bill of exchange, or in connection with business of collections. The major institutions that are carrying on the banking business in India are State Bank of India and their associates, nationalized banks, foreign banks having branches in India, cooperative banks, rural banks, and private sector banks. As a function of modern commercial banks, the main ones are accepting money for deposits, checks and acceptance of checks from depositors. These are the main functions of commercial banks. Loans and advances and granting of the same. Securities and dealing in securities on its own account or on behalf of customers. Issuing guarantees and opening letter of credit. Foreign exchange dealing. Transferring money, which is demand draft, travelers, checks, etc. Acting as trustee and executors. Merchant bank dealing. Next, we'll take a look at what is accounts and audit requirements of a banking company. As per Section 30 of Banking Regulations Act 1949, bank accounts must be audited by a person who is duly qualified by law in force to be an auditor of companies. Banking companies are required to obtain prior approval from Reserve Bank for appointment of auditors, reappointments and removal of them. Next, we'll take a look at bankers' books. Bankers' books are defined in Section 2.3 of Bankers' Book Evidence Act 1891. Bankers' books include ledgers, day books, cash books, account books, and all records used in the ordinary business of a bank. According to the slip system of posting, all cash receipts and payments are recorded in cashier's books and afterwards in pay-in slips, withdrawals and checks that are entered first in the customer's account and then later to day books. Various ledger books used in the banks are paying cashier's counter cash book, receiving cashier's counter cash book, current accounts ledger, savings bank accounts ledger, fixed deposit accounts ledger, recurring deposit accounts ledger, loan ledger, investment ledger, bill discounted and purchases ledger, and customer acceptances, endorsements and guarantee ledger. Various other books including registers and memorandum books are also used and maintained by the banks, and these are 1. Securities register, 2. Clearing register, 3. Draft register, 4. Collections register for bills, 5. Safe deposit vault register, 6. Letter of credit register, 7. Dishonored checks register, 8. Bills for collection register, 9. Share security register, 10. Jewelry register, 11. Safe custody register, and 12. Standing orders register. The principal books are books such as cash book and general ledger. So in cash book, what happens is that it's into cash book, the results are summarized and disclosed by receiving cashier's counter cash book and paying cashier's counter cash book. General ledger contains control accounts for revenue accounts, subsidiary ledger, and accounts of assets not covered by subsidiary ledger. This would mean all documentary evidence and support documentation of the transactions will be kept alongside the control accounts which are contained in the general ledger. Ledgers are maintained on their self-balancing system in every bank. Separate control accounts exist in general ledger for each subsidiary ledger. Once in every 2 weeks, the totals of the balances of all accounts in each subsidiary ledger is compared with the balance of relevant control accounts in the general ledger. To say the least, a trial balance is prepared of personal ledgers and agreed with general ledger control accounts and is done as an additional activity, normally involves preparation of daily trial balance of the general ledger. Next, we'll see what is presentation of profit and loss account in banks. So, profit and loss account in banks. The format and concept of profit and loss account is as per third schedule, Form B, for banking companies. And while presenting the profit and loss accounts, items are listed down under income, expenditure, profit and loss, appropriations, etc. Under income, the interest earned is as per schedules, which are in the banker's books. Interest earned is as per schedules, and there are 4 schedules which are used in profit and loss account in banks. One for interest earned, which is schedule 13. For other income, it is schedule 14. For interest expended, it is schedule 15. And for operating expenses, it is schedule 16. So these schedules are listed down also alongside the profit and loss account. We'll see what each of these schedule means in this section. So the following describes schedules which are in revised formats with respect to the financial statements published yearly. So first is schedule 13, which is interest earned. This schedule includes interest or discount earned on advances or bills, equally applicable to all loans and advances like cash credit, demand loans, overdraft, income on investment, interest on balances with Reserve Bank of India and other interbank funds. Schedule 14 is other income, and this includes commissions, exchange and brokerage, which includes remuneration on services and commissions on collections, letting out of lockers and guarantees, commissions on government business, etc. Profit on sale or investments, which includes profit and loss on sale of securities, furniture, land and building, motor vehicles, etc. And profit on revaluation on investments. And from this, we are lessening loss on revaluation on investments. So this is what should be there as per Schedule 14, which is under other income. This also includes profit on sale of land and buildings and other assets, profit on exchange transactions, including foreign exchange, commissions and charges, also interest, and income earned by way of dividends from subsidiaries, joint ventures in India and abroad, as well as miscellaneous incomes, which are out of godowns, rents, etc. Next is Schedule 15, which is interest. This includes interest on deposits, interest on Reserve Bank of India, especially interbank borrowings. And now it is Schedule 16, which is operating expenses, where in this schedule includes payment to and provisions for employees, rent, taxes and lighting, printing and stationery, advertisements and publicity, as well as depreciation of bank's property. This also includes depreciation of banks' motor vehicles, other vehicles, furniture, electric fittings, vaults, lifts, leasehold properties, etc. In operating expense, if it is included, it includes directors' fees and allowance, auditors' fees and expenses, law charges, postage, telegram, telephones, repair and insurance charges. Presentation of balance sheet in banks. The format and concept of balance sheet according to third schedule Form A is what is shown in this section. So it is according to third schedule Form A, form of balance sheet and end of financial year, which is where it is shown. It has capital and liabilities. Capital is as per Schedule 1. Reserves and surplus is as per Schedule 2. Deposits by Schedule 3, borrowings by Schedule 4, other liabilities and provisions by Schedule 5, cash and balances with RBI as per Schedule 6, balance with banks and money at call and short notice by Schedule 7, investments by Schedule 8, advances by Schedule 9, fixed assets by Schedule 10, other assets by Schedule 11, and contingent liabilities by Schedule 12. So we'll take a look at what each schedules mean and how it is used in forming the balance sheet. So the following descriptions are for notes containing guidelines of Reserve Bank of India as per revised formats in compliance to the financial statements published yearly. So we'll see what each of the schedule means. Schedule 1, which is capital. The capital is fully owned by central government in the case of nationalized bank, and this schedule is equally applicable to nationalized banks, banking companies incorporated outside India, and other banks with published authorized capital, issued capital, subscribed capital, and called up capital, with additions of forfeited shares and deductions on calls unpaid. The capital owned by central bank on the date of balance sheet should be shown, including contributions by it towards World Bank projects. The amount brought in by bank by way of startup capital should also be shown in the schedule. The deposit amount kept by RBI under subsection 2 of section 11 of Banking Regulations Act 1949 should also be shown. Call in arrears will be deducted from called up capital, while paid up value of forfeited shares will be added forming paid up capital. Schedule 2, Reserves and Surplus. In this schedule, statutory reserves, capital reserves, securities premium, balance of profit and revenue, and other reserves are shown. Changes in the above item, including fresh contributions made by the government, need be shown under this schedule. Reserves created in terms of Section 17 or other sections of Banking Regulations Act must be disclosed. Premium on issue of share capital may be shown separately. Revenue reserve mentions any reserve other than capital reserve should include all reserves than those that are separately classified. In Schedule 3, which is demand deposits, so in this schedule, demand deposits from banks and from others are included along with savings bank deposits, term deposits from banks and others, bank deposits from bank branches as well as deposits from bank branches outside India are included. Schedule 4, it is borrowings. Borrowings include borrowings in India obtained from Reserve Bank of India and other banks, borrowings outside India including secured borrowings. They should also include borrowings and refinance obtained from cooperative banks and commercial banks. This should also include borrowings and refinance obtained from Industrial Government Bank of India, Export-Import Bank of India. So it is Industrial Development Bank of India, Export and Import Bank of India, National Bank for Agriculture and Rural Development, and other institutions. Schedule 5 is other liabilities and provisions. So this schedule includes bills payable including drafts, telegraphic transfers, traveler's check, and inter-office adjustments. Also include interest accrued but not due on deposits and borrowings as well as other provisions. Schedule 6 is cash and bank balances with Reserve Bank of India. So this may include cash in hand including foreign currency, balances with Reserve Bank of India, current account and other accounts. Schedule 7 is balances with banks and money at call and short notice. So in India, this includes balances with banks in current accounts, in other deposit accounts, and money at call and short notices. Outside India, this may include current accounts, deposit accounts, and money at call and short notices. So this may also include balances held by foreign branches and balances held by Indian branches of bank branches outside India. Schedule 8 is about investments. Investments in India includes investments in government securities. They should include central and state government securities and government treasury bills, which should be shown at book value. In notes, differences between book value and market value should be given. Investments in India also includes investments in approved securities, investments in shares, investments in debentures and bonds, and investments in subsidiaries and joint ventures. Investments outside India includes government securities including local authorities, subsidiary and joint venture abroad. All foreign government securities encompassing securities issued by local authorities, as well as investments made in the share capital of subsidiaries floated outside India, should be included and classified under this schedule. Schedule 9 is about advances. So this schedule includes bills purchased and discounted, including secured and unsecured advances, cash credits, overdrafts, and loans payable, as well as term loans secured by tangible assets and covered by bank or government guarantee. Advances in India to priority sectors, public sectors, and banks, as well as advances outside India, which is due from banks, bills purchased and discounted, as well as syndicate loans are also included under this schedule. Schedule 10 is about fixed assets. Fixed assets include premises as well as other fixed assets such as furniture and fixtures. Premises partly or fully owned by the banking companies include residential premises should be shown under this schedule. From during an year ago, if premises and fixed assets are included, deductions and depreciations for the year should be shown under this schedule. Every balance sheet should show after the first balance sheet with subsequent reduction of revaluation also should show the revised figures for a period of 5 years in this schedule. Schedule 11 is other assets, which is inter-office adjustments, interest accrued from investments and advances, tax paid in advance, stationery and stamps, non-banking assets acquired in satisfaction, etc. Schedule 12 is about contingent liabilities, which includes claims against banks, liabilities for partly paid investments, liabilities for outstanding foreign exchange contract, guarantees given on behalf of constituents in India, acceptances and endorsements. So this completes balance sheet and the different schedules on which it is actually formed towards the end of the financial year. Now we'll take a look at account submission. The period for submission of balance sheet and profit and loss account to RBI by banks can be extended by RBI for a period of 3 months. As per Section 31 and 32 of the Banking Regulations Act 1949, copies of balance sheet and profit and loss accounts in triplicate or in 3 copies should be prepared under Section 29. An auditor's report under Section 30 must be submitted to RBI. This should be done within 3 months from the end of period that is referred to in the documents. Next is account publication. Rules regarding publication of accounts of banks has been prescribed in Rule 15 of the Banking Regulations Act 1949. As per the Banking Regulations Regulating Companies Rules 1949, bank accounts and auditor's report shall be published in newspaper which is in circulation at a place where the banking company has its principal office is permitted. This should be done within 6 months from the end of period to which all relate. And finally, it is conclusion where we say a banking company must have a chairman working in a whole-time appointment for 5 years in time. He may become a director of a subsidiary of the banking company or of a guarantee company registered under Section 25 of Companies Act. But he cannot take up any other appointment. This chairman is appointed by the board of directors. In the case of nationalized banks, he is appointed by the central government. So this sums up final accounts of banking companies. Thank you.